What if you could invest in the very engine of India's economy with just a single click? Well, today we're looking at a financial product that's designed to do pretty much that. We're going to demystify the DSP BSE Top 10 Banks ETF, breaking down what it is, how it works, and most importantly, who it might be right for. All right, let's get right into it.
I think the best place to start is right here, with this simple but really powerful statement. It's pulled directly from the fund's own documents, and it just perfectly sets the stage. It gets to the very heart of why this sector is so important. Think about it. Banks are basically the circulatory system of an economy. That's the whole idea behind this investment.
So here's our game plan for today. We'll kick things off with the big picture, why Indian banks are such a big deal. Then we'll zoom in on this specific ETF. We're going to pop the hood to see how it works, weigh the all-important risks and rewards, and then wrap up by helping you figure out if it actually makes sense for you. Okay, so first things first, let's tackle that foundational question. Why should we even be focusing on Indian banks? What is it about them that makes them such a critical piece of the market puzzle?
Well, it's because India's biggest banks are just part of the economy. They're basically the engine driving it forward. They handled the whole shebang, from huge corporate loans to the credit that lets people buy cars and homes. They really are the backbone of the market. And, they've got these structural advantages, right? Unlike a hot new tech startup that could get disrupted tomorrow, these banking giants are so deeply woven into the country's economic fabric.
All right, so we've got the why this sector is so important. Now, let's talk about the how. How does a regular investor, like you, get a piece of that action? Well, that's where this specific investment vehicle comes into play. And for anyone who might be a little new to this, let's quickly break it down. An ETF, or an exchange-traded fund, is basically like a prepackaged basket of investments. In this case, it's a basket of stocks. So instead of going out and buying shares in 10 different banks one by one, an ETF lets you buy that entire basket in one single go, just like buying a single stock. Super simple. And the specific fund we're zoning in on today is this one, the DSP BSE Top 10 Banks ETF. The name really tells you everything you need to know. It's designed to give you exposure to the top 10 banking stocks that are listed on the Bombay Stock Exchange, or the BSE. Now pay close attention to the language on this slide because it's key. Its goal is to replicate the performance of the index. See that? It's not trying to be a hero and beat the market, it's just trying to be the market for these top 10 banks. And that little phrase, tracking error, that just means there can sometimes be a tiny little gap between how the fund does and how the actual index does.
So we know its mission is to mirror the top 10 banks, but how does it actually do that? Let's peel back the layers and take a look at how this thing is really put together.
This brings us to a really important concept. This fund is passively managed. That means there isn't a star fund manager in a fancy office trying to pick winning stocks. Nope. The strategy here is way simpler. It's almost automatic. It just buys the stocks that are in the BSE Top 10 Banks Index in the exact same proportions. That's it.
And this chart really visualizes that strategy perfectly. As you can see, the fund's own documents say that almost all of its money, at least 95%, is going to be invested directly in those stocks from the index. That tiny little sliver of cash, that's just there for day-to-day operational stuff.
So what's actually in the basket? Take a look at this. This shows the top holdings, and what just jumps out at you right away is the concentration. I mean, wow! HDFC and ICICI Bank alone make up more than half of the entire fund. That's huge. It means the performance of just two companies is going to have a massive, massive impact on this ETF.
And that heavy concentration leads us straight into what is arguably the most important part of any investment decision, really understanding the trade-off. What's the potential reward, and what are the risks you have to be willing to take on to get it?
The pros are pretty clear, right? You get direct access to that economic engine and its biggest players. But the cons? Well, they're just as clear. You are putting a lot of your eggs in one basket. This isn't a diversified fund spread across the whole market. You're making a very specific, concentrated bet on the Indian banking sector. And hey, don't just take my word for it. The fund's provider is incredibly upfront about this. This right here is the official risk-o-meter from their documents. Notice it's not labeled moderate or even high. It is explicitly, clearly labeled very high risk. That's a critical piece of info for anyone even thinking about this. So what that really means for you is that your fortune with this ETF is directly chained to the health of the Indian banking industry. If the economy slows down or if new regulations hit the banks, this fund is going to feel it.
There's really nowhere to hide within this investment.
Okay, so with all of that on the table, let's bring it all home. Using the guidance straight from the source, who is this kind of super-focused, high-risk ETF actually built for?
Well, the fund documents themselves suggest this might be a good fit if you're specifically looking for a simple, low-cost way to get exposure to these big, established banks. And this part's really important. If you have a long-term mindset, we're not talking months, we're talking more than 7 years. This is definitely not for short-term speculation.
And on the flip side, they give some pretty clear warnings too. You should probably hit the pause button on this one if you're the kind of investor who gets nervous with big market swings. If that very high-risk label just doesn't sit right with you, or if you're looking for an investment that tries to outsmart the market, then this probably isn't the one for you.
In fact, the fund provider pushes that long-term idea even further. They suggest an ideal holding period of 10 years or more. That really tells you everything. This is designed as a long-term, strategic bet on the fundamental growth story of India's entire banking sector.
So, we end on this question, which really wraps it all up. This ETF offers a really simple, direct, and very concentrated way to invest in the backbone of the Indian economy. The real decision for you as an investor is whether a targeted, high-risk bet like this has a place in your own overall financial strategy.